The stock market is over, and you should get out before Trump triggers a full-blown recession. That's what the headlines want you to believe. It's everywhere. Breaking news banners, doom threads on social media, people yelling, "Sell everything," like it's a fire drill. And the same question keeps coming up. Should I sell now before it gets worse? Before you do anything emotional, take one breath. Because there's more happening here than the panic narrative. And if you understand what's actually driving this sell-off, you'll stop reacting like a victim, and you'll start thinking like someone who can profit from chaos. I'm going to break down the 3 main triggers behind this crash setup, why they matter, and what you can do to benefit from the mayhem without gambling your future. This isn't politics. I'm not here to cheer for anyone. As an outsider looking in, I care about one thing: what it does to markets and what it does to investors like you and me. And here's the truth. Every major market crash has a cause. This one isn't random. It's a chain reaction. And those chains have a few clear links. So let's get into it. Trigger number 1 is the trade war. And before you roll your eyes and say, "That's just politics," understand this. Tariffs are not politics to markets. They're numbers. They're attacks. Attacks that hits corporate margins, consumer prices, supply chains, and inflation expectations. And inflation expectations move interest rates. And interest rates move the entire stock market. So yes, it matters. Now, trade wars always sound good in speeches. They get sold as protecting jobs, fighting unfair competition, bringing manufacturing home, standing strong. And some of that can be true in specific industries, in specific time windows. But broad, escalating tariffs have a long history of creating second-order effects that people don't see until it's too late. If you want the cleanest case study, you go back to 1930. The U.S. passed the Smoot-Hawley Tariff Act. The idea was simple: tax imported goods, protect domestic producers. On paper, it sounded patriotic and logical. In practice, it was gasoline on an already burning economic fire. Other countries retaliated. Trade collapsed, exports fell, supply chains broke. Businesses that relied on global sales and inputs got squeezed from both sides. Jobs disappeared. And instead of cushioning the downturn, it helped turn a recession into something far worse. Now, I'm not saying history repeats exactly, but history rhymes. And when you see tariffs used aggressively as a policy weapon, you need to model the risk. Because the market isn't scared of tariffs as a concept. The market is scared of uncertainty, retaliation, and inflation. Tariffs don't just hit foreign producers. They hit domestic consumers. They hit domestic businesses that import components. And they hit domestic businesses that compete with foreign goods in complex ways. Here's the most important thing most people don't understand. The person who pays the tariff at the border is not the person who ultimately carries the cost. Businesses don't just smile and absorb higher costs out of kindness. They pass costs on. They change product specs. They cut headcount. They shift sourcing. They raise prices. So when tariffs rise, you often get higher prices on things people actually buy: cars, appliances, electronics, building materials. Then food gets more expensive in indirect ways because transport, packaging, inputs, and supply timing get disrupted. And suddenly the trade war isn't a macro headline. It's your weekly shopping bill. Now add retaliation. Because the other side doesn't just sit there. They respond with their own tariffs, their own restrictions, their own trade alignment. And that's when a trade war becomes a confidence war. Investors start asking, where is this going? Which industries get protected and which get punished? How long does this last? Do we get a negotiated outcome or do we get escalation? And that uncertainty alone can push companies to freeze decisions, delay hiring, delay capex, delay expansions. And those delays show up in earnings. Here's the part that's uncomfortable but true. Even if you believe tariffs are strategically useful long-term, markets can still crash short-term if implementation is chaotic. Because markets don't price ideology, markets price cash flows, and cash flows hate sudden cost shocks. Now, there's another layer most people miss. When a country uses tariffs aggressively, other countries often start building paths around it. New trade alliances, new settlement mechanisms, new suppliers, new corridors. So the more the US isolates itself through trade friction, the more other countries get incentivized to reduce dependence on US trade where possible. That doesn't happen overnight, but it doesn't need to. It just needs to be enough to reduce growth and increase uncertainty. Now, here's my honest view. I don't think the end goal for a dealmaker type personality is permanent high tariffs. High tariffs are a blunt weapon. They create pain. They create backlash. They create inflation. They create uncertainty. What seems more likely is that tariffs are being used as leverage, a negotiation tactic, a pressure tool. The goal may not be tariffs forever. The goal may be better terms. But even if that's true, the market can still suffer, because the path to a deal can be chaotic, and chaotic paths create market drawdowns. So when you see tariffs being announced, reversed, escalated, paused, adjusted, what the market is reacting to is not trade policy. It's unpredictability. And unpredictability is one of the biggest killers of investor confidence. That's trigger 1. Trigger 2 is geopolitical stability risk, specifically the messaging around alliances like NATO. Now you might be thinking, why would that crash stocks? Because markets are not only about earnings. Markets are also about risk premiums. When the world feels stable, investors demand less compensation for risk, valuations rise, credit flows, growth assets do well. When the world feels unstable, investors demand more compensation for risk, valuations compress, money moves to safety, and volatility spikes. If the US signals that it may reduce or condition its commitment to major security alliances, that can create a perceived power vacuum. And power vacuums get filled, sometimes by negotiation, sometimes by aggression. And markets hate that kind of uncertainty because it creates tail risk. Tail risk is the stuff that doesn't happen often, but when it does, it hits hard. More instability means higher military spending, less predictable trade relationships, and often spikes in energy prices. Energy prices are a stealth tax on the entire economy, because when energy rises, transport rises, production costs rise, food costs rise, and that feeds inflation. And inflation feeds rates, and rates feed valuations. You see how everything keeps coming back to the same place? Rates, liquidity, confidence. So even if you never trade geopolitics, geopolitics trades you. Now, trigger 3 is the one that sounds crazy at first, but it's worth discussing as a market theory, not as a guaranteed fact. The theory is this. What if the administration doesn't hate a market crash? What if it actually benefits from one, temporarily? Let me explain the logic without turning it into a conspiracy. High interest rates slow the economy. They make borrowing expensive. They pressure housing. They pressure speculative assets. They increase debt service costs. And there is one problem that is huge and impossible to ignore: the US government's debt load. When interest rates are high, the cost to service that debt rises, not in a dramatic TV way, in a math way. Imagine you're carrying an enormous credit card balance. If your interest rate is 10%, you're paying a fortune just to stand still. If your interest rate drops to 3%, your yearly interest cost collapses. Now scale that logic to sovereign debt. If rates can be pushed lower and refinancing happens lower, the government saves staggering amounts over time. So here's the theory part. The central bank is technically independent, A president can't just order rate cuts, but the central bank reacts to economic conditions. If markets crash hard and recession risk rises, the central bank is more likely to cut. So the theory suggests a controlled shock could force the central bank's hand. Again, I'm not saying this is definitely happening. I'm saying this is the kind of logic traders model. Because markets are always asking, what is the incentive? And incentives matter. Now here's the key. Whether or not anyone is intentionally trying to crash markets, the debt and rate dynamic is real. If the government wants lower rates and the central bank is reluctant, then deteriorating market and economic conditions increase pressure for easing. So the market becomes a battlefield of expectations, and that's why you can get violent moves. Not because the world ended, because the macro chess game is messy. Now pause. If you've heard all that and you're thinking, okay, so we're doomed. No, that's not the right conclusion. The right conclusion is, crashes are part of markets. They're not rare aliens. They're a feature of the system. And every major crash creates two groups: the people who panic and lock in losses, and the people who stay calm and reposition. That's the difference. The stock market doesn't transfer wealth from the rich to the poor. It transfers wealth from the emotional to the disciplined. Now, I'm not telling you to buy the dip blindly. I'm telling you to stop being the person who reacts to fear at the exact wrong time. Because the best opportunities don't feel comfortable. They feel scary. In 2008, buying felt insane. In 2020, buying felt insane. And yet, those who bought quality assets during those windows did very well over the following years. So instead of freaking out, you prepare. You make smart moves. You keep risk in check. And you position for the recovery. Because history shows that broad U.S. market crashes have consistently been followed by recoveries, even if the path is ugly. Now let's get practical. How do you benefit from this crash without blowing yourself up? Here's the framework I use. First, you build a financial foundation. Before you even think about opportunity, you need protection. That means an emergency fund. 3 to 6 months of living expenses is a common baseline. If you're in a volatile job or you have dependents, make it bigger. And you eliminate high-interest debt. If you're paying 18% on a credit card, that's not debt. That's a financial emergency. Paying down high-interest debt is a guaranteed return. It's one of the few guaranteed returns you'll ever get. Now, once that foundation is built, you can invest from strength instead of desperation. Because the worst thing is being right about the market and still losing because you needed the cash. Now, if you've never invested before, crashes can actually be a decent time to start if you start with a sane approach. Because prices are lower, valuations are less euphoric, and you can build positions without paying peak prices. But nobody can time the bottom. Not you, not me, not the pros. So don't try. Instead, use consistency. This is where dollar cost averaging comes in. You invest a fixed amount on a schedule, weekly or monthly, regardless of what the market is doing. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, you reduce the risk of buying everything at the top. Now, if you're already investing, the worst mistake you can make in a crash is panic selling. Because panic selling locks in losses, and it usually happens after the damage is done. People sell when fear peaks. Then they wait for things to calm down. And they buy back after prices recover. That is the classic retail cycle. Sell low, buy high. And it's why most people underperform. So instead of asking, should I sell now? Ask this. Do I own assets I would be happy to own for the next 5 to 10 years? If the answer is yes, you don't panic sell. You manage risk. If the answer is no, if you own hype, leverage, garbage, or things you bought with no plan, then the crash is revealing the truth, and you may need to clean house. Because not every stock survives. Indexes recover over time, historically. Individual companies can fail. So you need discrimination. Not everything deserves your loyalty. Now, the next principle is discipline. Crashes aren't random. They cluster, they follow cycles, and it helps to understand the magnitude ranges. A correction is roughly a 10 to 20% drop. These happen frequently, they're normal. A bear market is typically 20 to 40%. These happen every few years. They can last months, sometimes longer. A deep collapse, more than 40%, is rarer. But historically, major collapses have been followed by significant recoveries in the US market over time. The mistake people make is thinking every drop is the end. It usually isn't. But the drop always feels like the end while you're inside it. That's why discipline matters. Now here's a simple emotional rule. When you feel the strongest urge to do something dramatic, it's often the worst time to act. Because your brain is reacting to fear, not data. So you build rules ahead of time. You decide what portion of your portfolio is long-term core that you do not touch. What portion is tactical that you can adjust? What is your maximum loss on a position before you exit? How much cash do you keep so you're not forced to sell? If you don't have rules, you have emotions. And emotions are expensive. Now the next piece is diversification. Putting all your money into one thing is a recipe for regret, especially in macro-driven regimes where the same policy shock can hit an entire sector overnight. Diversification doesn't mean owning 30 stocks that all behave the same. It means spreading exposure across different drivers. That can include broad equity exposure, some bonds depending on your risk profile and duration risk, some real assets like real estate where appropriate, and for some people, a small allocation to hard assets like precious metals, and for others, a small allocation to alternative assets like crypto if they understand the volatility. The exact mix depends on your goals, your age, your income stability, and your temperament. But the principle is the same. Don't bet your entire future on one narrative, because the market's job is to humiliate single narratives. Now, there's also a practical strategy that can help during downturns. Dividends. Dividend-paying companies often hold up better because even if price drops, cash flow continues. Dividends are not magic. Companies can cut dividends. But high-quality dividend payers can provide a psychological anchor when markets are ugly, because you're still being paid while you wait. Now, if you want one simple and boring approach that beats most people, it's this. Build a core portfolio of quality, diversified exposure. Invest consistently. Avoid leverage. Maintain liquidity. And rebalance when fear creates dislocations. That alone puts you ahead of the majority, because the majority will do the emotional thing. Now let's talk about what you should not do in a crash. Don't go all in because you feel like it's the bottom. Don't take on margin because you think you're smarter than volatility. Don't chase the one stock that's down 80% hoping it will bounce 300%. Sometimes it does. Often it doesn't. And that's how people blow up. Also, don't hide in cash for years waiting for certainty, because cash quietly loses purchasing power in inflationary regimes. And even when inflation looks contained, the opportunity cost of sitting out recoveries can be enormous. The goal isn't to avoid discomfort. The goal is to avoid permanent damage. Now let's connect this back to the 3 triggers. If the trade war escalates and uncertainty persists, you can see pressure on growth. You can see volatility. You can see inflation risk from tariffs. If geopolitical stability feels less certain, risk premiums rise. If the debt and rates dynamic pushes toward eventual easing, you can see a setup where a short-term shock is followed by a powerful rebound as rates fall and liquidity improves. So there are multiple paths, and that's why you don't make one dramatic all-or-nothing move. You build a plan that survives multiple outcomes. Now here's the final truth that should calm you down. The market is not designed to be comfortable. It's designed to test you. It punishes panic. It punishes certainty. It rewards discipline. The best investors aren't the ones who predict every headline. They're the ones who have a process. So if you're staring at your portfolio right now and you're anxious, do this. Step 1. Confirm your cash buffer and your monthly bills. Step 2. Remove or reduce positions you don't understand or can't hold through volatility. Step 3. Commit to a simple investing schedule so you're not timing emotionally. Step 4. Diversify across drivers. Step 5. Remind yourself that crashes are not the end of investing. They are the tuition. The people who learn the lesson get paid. The people who repeat the emotional cycle pay forever. So no, this is not the time to fear the market. It's the time to prepare. It's the time to be disciplined. And it's the time to position yourself so that when the rebound comes, and historically it does, you're not watching from the sidelines with regret. You're participating. Calm, systematic, patient. That's how you win when the headlines are trying to scare you into losing.